You think the S&P 500 moves based on earnings? That's cute. You think it moves based on how many iPhones Apple sells? Wrong again. For the last 20 years, the global stock market has been floating on a sea of essentially free money printed in Tokyo. And folks, the tide just went out. Let's strip away the fancy Wall Street jargon. Forget interest rate differentials for a second. Let's talk about the yen carry trade. It sounds boring, like an accounting seminar, but it's actually the world's biggest, most dangerous gambling addiction. Here's how it works. Imagine you have a credit card that charges you 0% interest. Actually, imagine it charges you negative interest. They basically pay you to borrow money. That was the Japanese yen for decades. So what do the smart money guys do? They borrow billions of yen for free. Then they sell that yen, buy US dollars, and dump it into things that actually yield money, like US Treasury bonds or, more recently, tech stocks. It's the ultimate arbitrage. You borrow at 0% in Japan, earn 5% in the US. You pocket the difference. It's free money. It's an infinite money glitch. And because it was so easy, everyone did it. Trillions of dollars of carry trade positions built up. It was a crowded party, and everyone was drunk on liquidity. Now, meet David. David is a product manager. He doesn't care about Japanese bond yields. He cares that his 401k is up 20% this year. He thinks he's a genius stock picker. But David doesn't realize his portfolio is essentially leveraged to the hilt by hedge funds borrowing Japanese yen. David is the unwitting passenger in a car driven by a drunk gambler. Then the unthinkable happened. The Bank of Japan raised rates, just a tiny bit, but that was enough. Suddenly, that 0% loan isn't 0% anymore. And worse, the yen started getting stronger. If you borrowed 100 million yen when it was cheap, and now the yen is expensive, you owe way more dollars to pay it back. This is the global margin call. All those hedge funds, they're suddenly underwater. They have to pay back the yen loans now. How do they get the cash? They have to sell their most liquid assets. And what are their most liquid assets? David's favorite US tech stocks. They aren't selling because they hate Apple. They're selling because they have to cover their debts in Tokyo. So here is the reality check. The easy mode of the last decade, where bad news meant the Fed would print money and stocks would go up, is broken. The Fed can't fix a currency crisis in Japan. We're seeing a structural reset. The volatility is the point. The carry trade is unwinding, and it's dragging your passive index fund down with it. So what's the move? Stop playing the game by the old rules. Treat your cash like ammunition, not a mattress. And for the love of God, stop obsessing over PE ratios. That's like checking the thermostat while the house is on fire. Start watching the yen. That chart isn't just currency anymore. It's the global market's heart rate monitor. When it beeps, Wall Street jumps. All right, the first step is to be aware of the danger and getting geared to prepare. Knowledge is power. I read the 800-page IMF report so you don't have to. We're going to navigate this mess together. See you in the next one.